welcome to our February regulatory brief, your monthly checkup for the most important developments of the month of January 2026. I am Stephanie Lyon, SVP of Regulatory and Risk Intelligence at Ncontracts, and I'm joined by the two people you want in your corner when the rules get messy. I'm talking about Robert Brosh, our Director of Regulatory Intelligence, and Jenna Sakarowicz, our Regulatory Compliance Counsel. We'll start with big industry-wide developments, then zero in on our depository institutions, and wrap up with issues affecting the mortgage industry. First up, we have the CFPB. So let's go ahead and address the noise that we've been hearing that the CFPB is being defunded, that it's shut down, that it's on life support. I'm here to give you the skinny on where we actually are with that and what it means for you. First of all, you need to know that the CFPB is still operating. We did get some clarity on the debate as to whether the Federal Reserve's ongoing financial losses meant that the CFPB couldn't get legally funded. And a federal judge in DC actually ruled that the Dodd-Frank Act looks at how the Fed's revenue is working, not whether it made a profit, meaning that the CFPB is not legally blocked from asking for funding as the DOJ's legal opinion had stated in the past. So we are still expecting the CFPB to fully function, and the CFPB has already requested and received $145 million in funding from the Federal Reserve, which only really covers the first quarter of operations in 2026. So we'll be back to hear if they request more and to see what's going on in the future. But that does also mean we're not going back to just the way things were working in the past. Still, the new administration is not very happy with the way that the CFPB was functioning. So we do know that federal enforcement is going to continue to be very uneven. We know that state attorney generals are becoming more aggressive, and we know that private lawsuits are multiplying and likely to continue to multiply in 2026. That just simply means that our compliance risk is going to come from many directions. And all of this uncertainty around the CFPB funding is now showing up in some very practical ways for the industry, including how the Bureau communicates routine compliance updates to our industry. Right, Jenna?
Yeah, that's right. In January, the CFPB had announced that they are going to discontinue HMDA email delivery service. Now, the Bureau stated that this change was due to operational constraints and is going to be an important change on how HMDA platform updates and announcements are going to be communicated. So now, after January 20th, subscribers to the HMDA mailing list are no longer going to receive email notifications. The Bureau had acknowledged that users deem this information and this communication important, and they were urged to visit the CFPB's HMDA Updates and Notes webpage for access to timely information. Now, remember that your HMDA submissions are due March 1st every year. Since that falls on a weekend this year, it's going to be March 2nd. And take this time to make sure you're reviewing your loan application register, your LAR for completeness, and address any edits and warnings. Make sure you're catching any missing or duplicate records, and schedule the executive review meetings if you haven't already, so you're giving your executives adequate time to review that data before submission. And don't wait until the day before. We've seen that financial institutions who wait until the day or even the week before have had issues making submissions. So prepare ahead, be ready to submit that data before that March 2nd deadline.
Great advice, Jenna. And let's go ahead and stay on the CFPB as Robert gives us an update on the fair lending landscape.
Yeah, so the CFPB and the Department of Justice are withdrawing a joint statement on the Equal Credit Opportunity Act and non-citizen borrowers. So really, the agencies were indicating that this statement from 2023 created an impression that financial institutions can't consider immigration or citizenship status in lending decisions. In reality, that's never actually been prohibited. Citizenship and immigration status are not explicitly protected characteristics under ECOA. Really, the concern comes up when those statuses serve as a proxy for protected characteristics like national origin or ethnicity or race. And that is typically demonstrated through a disparate impact analysis. And so the withdrawal of this statement really aligns with the broader trend of the agencies removing disparate impact from their examination expectations. I would advise consider continuing to follow the same methodology that has been accepted under more liberal leadership, and that is to ensure that you are making creditworthiness decisions that are based on this status because of a risk of non-payment. Very simple example. If I come into your bank or your credit union and I have a work visa that expires in 3 years and I'm applying for a 30-year mortgage, there is a high risk of non-payment, and therefore that can probably play a role in your creditworthiness decision and perhaps a justified denial. But if I come in with a permanent residence card and you deny me based primarily on the fact that I have a permanent resident card, then you are skirting a risky line and you might have a potential discriminatory impact there. We also had HUD, which was proposing to remove disparate impact under its Fair Housing Act regulations. First and foremost, I want to make it clear that this proposal and whatever comes from it doesn't mean that disparate impact is no longer a viable legal theory for discriminatory conduct. And that is because disparate impact is written into the Fair Housing Act itself, the statute itself, which covers actions that have discriminatory effects, not just intentional discrimination. And it is only within Congress's power to change that statute, not HUD's. Plus, we have the fact that disparate impact has been a fundamental aspect of civil rights laws and regulations applied by courts across the country for more than 5 decades. It is still valid under Supreme Court precedent from 2015. And again, it is valid because it was on a ruling of the Fair Housing Act itself, not HUD's implementing regulations. So whether HUD's rule as proposed is finalized, keep in mind fair lending risk based on disparate impact, based on your statistical disparities, is still present because of the right of private individuals to bring suit against your institution as a lender, as well as the right of state attorney generals to enforce the Fair Housing Act. Last one on fair housing, I promise, and that is we had a recent decision by the U.S. Supreme Court not to hear a discrimination case appeal, which left intact the Second Circuit Court's ruling. And really the issue around this case was that the Second Circuit upheld a jury instruction from the first court, the district court, that left out the word disproportionate when evaluating whether the practice of making a certain type of loan had an adverse impact on Black and Hispanic borrowers. And so really the claim by the lender was that by leaving out the word disproportionate, the disparate impact analysis removed the need to compare the impact of the practice against non-Black and non-Hispanic borrowers, generally your control group. So basically, even if a practice had impacted all racial groups equally, including white, then it could still be disparate impact. And that's a lot of legal jargon, but what I want you to take away is the fact that, there isn't a new standard in place for disparate impact where a disparity between a control group and a protected group doesn't need to be proven. The Second Circuit stated that by focusing the jury on a substantial adverse impact on African American or Hispanic borrowers, that instruction captured the necessary comparison between white borrowers to Black and Hispanic borrowers. So disparate impact case under the Fair Housing Act still requires an evaluation of how it impacts a protected group in comparison to a control group.
Thank you, Robert. And it is good to note that case you're talking about from the Second Circuit, that yielded a $700,000+ penalty against the lender. So just keep in mind, disparate impact is definitely still alive and well in the courts. The next 2 developments may sound very political on the surface, but for compliance teams, they're really all about risk decisions and public scrutiny. President Donald Trump has filed a $5 billion lawsuit against JP Morgan Chase and its infamous CEO, alleging that the bank closed accounts for political reasons. JP Morgan Chase has denied the allegations, stating that the account closures were based on legal, regulatory, and risk considerations, not politics. Whether this ultimately succeeds in the courts is really besides the point, because what really matters for our industry is that routine account closure decisions are now being reframed as public things that we need to discuss and political discrimination. So these decisions that could quietly live inside our AML, fraud, and reputation risk programs are now being pulled out into lawsuits, congressional hearings, and the media. This isn't just happening in a vacuum. The OCC, for example, has also weighed in on debanking practices. They recently released an agency findings from the supervisory review of just a few large banks focused on debanking practices. And what they found is that some banks are making decisions potentially to limit services or accounts, particularly around reputation or broad category-based exclusions, rather than the clear customer-specific risk factors that we see around anti-money laundering. Taken together, the lawsuit, the executive order, and the OCC's work sends the message that it's no longer enough for us to say that this is a risk-based decision to close an account or to simply reduce services. You have to be able to show how, why, and that consistency, right? So the questions I recommend you start thinking about when it comes to your account closure and service restriction policies are: number one, are we setting clear, objective standards? Number two, can we demonstrate that the decisions we are making are based on behavior, activity, or legal exposure, not viewpoint, affiliation, or optics? And number three, does our documentation hold up if reviewed by regulators, lawmakers, or even the court? At this point, account closure governance is litigation defense and reputation protection. So please make sure you're giving it the attention it deserves under the current administration. We're going to move ahead to the second update, and ahead of this year's midterms, President Trump has also revived a campaign proposal calling on Congress to enact a one-year 10% cap on credit card interest rates. To be very clear, this is not the law yet. There is no federal credit card specific APR in place, and there is no indication right now that Congress is even close to passing it. But compliance teams should still pay close attention because it reflects that growing political comfort with stepping directly into pricing decisions, especially when consumer affordability becomes a headline issue. We have seen this movie play out before, most recently with the federal push to eliminate the so-called junk fees, which temporarily shifted enforcement priorities and materially affected non-interest income for so many institutions. So the takeaways for compliance team include: expect that there's going to be renewed scrutiny around pricing fairness, disclosures, and consumer impact at both the federal and the state levels. Be prepared for board level questions about how rates and fees are set, explained, and defended, and recognize that even symbolic or temporary proposals like the one we have today can and does tend to influence future rulemaking, exams, and even enforcement priorities. So don't sleep on these two very important updates. We are going to go ahead and move down to depository institutions, starting with banks, where we have a little bit of rule shifting, right, Jenna?
Yeah, the FDIC has finally issued their final rule updating the sign and advertising requirements. Now, the agency had listened to industry comments regarding the 2023 rule, creating implementation headaches. So what's changed now? First, the digital sign itself. The old rule had very specific color codes and pixel sizes, but not anymore. Institutions now just need to use navy blue or black. There's no specific color code requirements. And institutions are also allowed to wrap text based on space constraints. Now, second, where your signs are displayed. For digital channels like your websites and mobile apps, the sign needs to be displayed in 3 places. We have the home page or the initial page, the login screen, and the first page of the deposit account opening process. The rule had removed the landing page requirement, finding that it was duplicative and institutions no longer need the FDIC sign on pages where customers may transact with deposits, because it became very confusing for customers when deposit and non-deposit accounts were appearing on the same screen. Now, we still need the non-deposit warnings, but only on pages that are going to be primarily dedicated to non-deposit products. So if customers are going to be clicking on investing or wealth management tabs, and that page is going to take them to a page that specifically focuses on investment products, then that page is going to need a warning. Now, third, ATMs. Institutions now only have to display the FDIC sign on the initial screen, not every transaction screen. And if ATMs were installed before April 1st of 2027, or any ATM that doesn't offer non-deposit products regardless of when it was installed, you don't need to use that digital sign. You could use physical signs instead. Now, the rule becomes effective March 2nd of this year and has a compliance deadline of April 1st of 2027, giving institutions just over 14 months to get everything in order. So make sure that you are using this time wisely.
Thank you, Jenna. Let's move on to issues affecting credit unions. And boy, do we have a lot of changes happening at the credit union level. Just recently, Chairman Hopman announced that he will be stepping down as the sole chairperson and board member of NCUA. He is going to stay in this agency until President Trump and the Senate confirm a new appointed director. But right now, that agency is truly under a lot of stress, especially with only 1 out of 3 directors currently functioning. So Robert is going to actually tell us what are the supervisory priorities that this chairman has imposed that may not be fully in fruition if he is to leave. But in any case, Robert, take it away.
Yeah, I mean, so take everything here with a grain of salt. Who knows? Whoever comes in next may have their own supervisory priorities, but this is what we have right now. So this is what your credit union should focus on at the moment. You know, it is fair to say that Chairman Hopman is kind of following the administration's lead with priorities and ideology. So, you know, I expect whoever replaces him will likely follow the same priorities. But we do have them. There were a few new focuses this year than in years past. You know, I think that goes without saying. First of all, though, what hasn't really changed, one of those items is credit quality. It is still a focus. Delinquency and loss rates now are at their highest in over a decade for credit unions. Last year, the agency flagged credit cards and used auto loans specifically, but this year it is focusing on broader portfolio stress, especially where you have a credit union funding with higher cost share certificates and borrowings. Second, kind of sticking along the financial theme, interest rate and liquidity risk aren't going away. Rates have started declining, but a lot of loans and funding costs haven't been repriced yet. So the NCUA is connecting this directly to a financial institution's capital adequacy, right? The ability for your credit union to absorb losses, and those unrealized losses on long duration securities in your capital markets can really limit your institution's flexibility when you need it the most. All right, so those are kind of the similar items. What is different for 2026? One, cybersecurity is no longer a standalone priority. Instead, it's been folded into a broader operational risk section alongside payment systems and fraud. And you know, it does reflect what we're seeing industry-wide. Cybersecurity, the attacks that we're seeing are definitely on the uptick. And then in terms of fraud, we saw from a report that I read from 2024, it hit 79% of organizations. I'm assuming in 2025, that number was probably higher. And so the NCUA did say that it is updating its exam procedures specifically to address that evolving threat landscape. BSA AML, you can expect some significant regulatory changes as FinCEN continues rolling out AML Act reforms. And so the focus really for your institution, right? We're in this time of uncertainty. What should we be doing? It really is focusing on your program and ensuring that it is truly risk-based, not just check the box program. It's understanding what customers you are serving, what geographies you are serving, and then also some of the higher risk products and services that you offer and ones where, those bad actors may be trying to take advantage of it. What is missing from the priorities is just as telling. Consumer compliance was not on the supervisory priorities. That means overdrafts, fair lending, which were explicitly called out in 2025, which of course that was under the Biden administration before the shift happened. But those aren't standalone priorities this year. Bottom line, NCUA is signaling a more streamlined approach. But again, don't mistake that efficiency or lack of resources for leniency. We know that risk exists elsewhere beside just the federal regulators, and even within the federal agencies themselves, NCUA specifically, examiners are going to be focused on whether you have the governance and capital to weather continued stress. A lot on the priorities. They kind of go hand in hand with the NCUA's deregulation initiative. So the NCUA has released, I think, 4 phases at this point. And they aim to remove some regulatory requirements for both federal credit unions and federally insured credit unions, either because they are obsolete, overly burdensome, or duplicative. And so some of the noteworthy items include changes to Catastrophic Act reporting. It is minimizing the requirements. It's extending the reporting deadline from 5 to 15 days to report when a catastrophic event has happened. It allows you to notify the NCUA generally rather than a specific regional director. And it also removes the specific list of documentation needed when reporting that catastrophic event. Kind of not exactly in line with the update that Jenna gave from the FDIC, but the NCUA is also proposing changes to their accuracy of advertising and notice of insured status rule. They are proposing to remove the official advertising statement requirement from advertisements and instead only require it in physical branches, your credit union's website, and any mobile app where members can open accounts or conduct transactions. There are a lot in this deregulation. There are many other items. I definitely recommend looking through those 4 phases. We have things like proposals to remove the 30-day notification requirement for terminating supplemental share insurance coverage, changes to engagement letters for outside auditors. Definitely a lot to go through, but it is important to note that if I were advising you, best practice is probably to continue compliance, removing your systems and controls that you have in place now to ensure compliance with all of the ones mentioned in this deregulation initiative may be costly to reinstitute in the future if we do have an administration that has a different opinion than the current leadership that we have.
Thank you, Robert. Let's go down to our last update, and that is for mortgage companies, where Jenna is going to tell us a little bit about what New York, the leading regulator right now, seems to be doing.
Yeah, New York has made a huge leap and expanded its CRA framework to include mortgage bankers. Now, non-bank mortgage lenders now originate approximately 64% of mortgages nationwide, which is up from 42% in 2014. They are dominant players in the mortgage market, but they've operated without CRA obligations. So now, when establishing this framework under the rule, the New York regulators had used the bank CRA framework as a model and made slight variations based on the lack of deposit-taking activity. The final rule applies to licensed mortgage bankers who originate 200 or more mortgage loans in the prior calendar year. It establishes assessment areas for both branch-based lenders and branchless lenders. So for branch-based lenders, your assessment area is going to be the regions around your physical New York branches, so similar to banks. And branchless lenders are going to establish in each metropolitan statistical area or non-metropolitan area where they originate at least 100 mortgage loans in the prior 2 calendar years. The rule also establishes 2 different tests. So we have the lending test, which is going to evaluate the record of meeting credit needs through mortgage lending activity, and then also the services test, which is going to evaluate systems for delivering mortgage loan products and your community development activities. Mortgage bankers that are subject to the rule are going to also be required to submit HMDA reports and other federal, state, or locally mandated reports, and any other additional documentation of community service activities that support the evaluation. The rule has a mandatory compliance deadline of July 7th of 2026. And I hope you haven't zoned out, even if you're not a New York mortgage banker. You know, the update and the shift it represents in the regulatory landscape is still applicable. States are really starting to step up and fill gaps that they're seeing themselves, and they're not waiting for federal regulatory agencies to fill them for them. States like Connecticut, Illinois, the Commonwealth of Massachusetts, they're subjecting CRA regulations to credit unions. So the philosophy is changing, and institutions that are operating in multiple states could be looking at some serious compliance fragmentation and may want to consider whether or not they're going to start adopting the highest compliance denominator, or whether or not they're going to go and have state-by-state assessments for each state they operate in. But either way, the institutions that start thinking and preparing now are going to be the ones that are best situated to weather those challenges.
Thank you, Jenna, and thank you, Robert. As always, if you're looking for a practical way to stay on top of regulatory activity as it unfolds, check out Ncomply, which is now enhanced with intelligent complaint management to help you spot issues earlier and connect those complaints to real compliance risks like Robert was mentioning. Thanks for joining us for our February regulatory brief. We'll see you again next month.